Hi, welcome to STANLIB's weekly economic podcast. My name is Kevin Lings and I'm the chief economist within STANLIB. These weekly podcasts are designed to unpack some of the key economic developments that have unfolded over the past week. And obviously this week we need to focus heavily on the latest developments in the Middle East, particularly the escalation of the conflict and what that has done to the oil price. The oil price over the weekend shot up very dramatically. At one point, it was trading in Asia at around $120 a barrel. It has subsequently eased off to closer to $100 or just over $100 a barrel. But at that sort of price level, it has huge implications for South Africa's petrol price and diesel price under recovery. And it's starting to set us up for a monster increase in our fuel price at the beginning of April. And I think we need to stay on top of those developments and just understand how severe an under recovery we have at the moment. Obviously, if the conflict were to be ended fairly soon, then our expectation is that the oil price would come back down quite sharply. And so it can dissipate as a concern. But in order for that to happen, clearly the conflict has to be resolved. And if I look at the latest developments, it doesn't feel like that's the case. If anything, the conflict has intensified. The second topic is the US labor market data that came out last week, particularly their main labor market report on Friday. It was very disappointing. They lost just over 90,000 jobs in the month. And so we need to unpack some of that. I don't think it is related to the impact of AI. Obviously, that keeps circulating as a theme. But if I look at the sectors in which the US has lost employment, it's across a broad range of industries. And I think it just reflects a softening of labor market conditions, but not necessarily an outright impact of the adoption of AI. So I think useful to unpack some of those developments. Clearly not a good environment right now for financial markets. Selling off quite a bit across a range of categories last week, all in response to the Iran war. And obviously the biggest concern there is the oil price and what that does for inflation and to some extent what that means for interest rates and economic growth. So we'll unpack some of those developments, but I think we've got to see it as an ongoing conflict that needs to be monitored very carefully. So let's start with a discussion on the latest increase in the oil price, developments over the weekend, and what that might mean for South Africa's fuel price next month and the implications of that for South Africa's inflation and interest rates. So as I mentioned in the introduction, the oil price spiked to about $120 a barrel in Asian trade. It's eased off to about $100 a barrel. So I'm going to use $100 as the reference point for the calculations. At $100 a barrel, it means year to date, the oil price is up 64.5%. That's a massive increase. And most of that clearly not reflected yet in our fuel price. So if I look at the official data for Friday, the under recovery on South Africa's petrol price was sitting at R4.64 a litre, and the under recovery on South Africa's diesel price sitting at R7.67. So what does that mean? It means that the diesel price has to go up R7.67 to be at the appropriate, at the correct level. That's a huge increase. Equally, the petrol price would have to increase by R4.64. Now, subsequent to the Friday estimate, obviously the oil price has gone up further, the currency is under pressure. And so what does the latest numbers mean for the under recovery? And what that suggests is that at this stage, the under recovery on the petrol price would be sitting at about R5 a litre, and for diesel about R8.30. So those are the sorts of increases that we can anticipate in April, presuming that the conflict remains in place, and clearly there could be potentially further upside risk. So as an example, let's say that the oil price went to $120 a barrel. The under recovery on South Africa's diesel price would probably be in the order of R10 a litre. Imagine that in 1 month, the diesel price goes up R10 a litre. We haven't had an increase like that ever. We haven't had an increase similar to the numbers we're currently estimating. So this is going to be a huge shock to South Africa's business and household sector in April, and there's not a lot we can do about it. There will be some discussions about can government step in and provide some sort of support? Well, unfortunately, we don't have much of a strategic oil supply, so there's a limited ability to use anything like that to offset the price effect. Equally, I don't think the government has the financial capacity to step in and provide a significant fuel price subsidy. The numbers get big very quickly, and so I just don't think that there's much scope to do that, certainly not on an extended basis. And so in truth, there's not a huge amount we can do, and so we've got to anticipate a substantial shock. So what do these numbers mean for South Africa's inflation rate? If I use the $100 a barrel and the prevailing exchange rate, then it means in April there's this possibility that South Africa's inflation rate moves up an additional 1.2 percentage points. That's huge. And so what that would mean is that instead of our inflation rate coming out at about 3.3%, potentially it moves up to 4.5%. Now, for some people that may not sound that substantial, but if you consider that we've got this new inflation target of 3%, we've made decent progress in moving towards the target, it would be incredibly unhelpful for inflation to move from 3.3 all the way up to 4.5%, because it would take us quite a bit away from the target, and clearly it would cause some anxiety about monetary policy. Then going forward beyond that, you would have to make a guess as to what happens to the conflict. If the conflict is resolved fairly quickly, then we would assume that the oil price will retrace back down to about $70 a barrel. So it would then quickly mitigate the potential increase that we're looking at now, and therefore become much, much less of a factor. So a lot of this depends hugely on how long the conflict lasts, and clearly there's no way of knowing that. Although if I look at the developments over the weekend, it does feel that it's becoming more protracted, does feel like it's become more intense. Doesn't look to us like there's a huge amount of discussion going on between Iran and the US. And so that's unsettling, because obviously in order to get the solution, you're probably going to need some sort of negotiated truce here, and it doesn't feel right now that that is in the making. So at this stage, I think most people are assuming this is going to last longer. I think the consensus estimate would be that this lasts about a month, but we don't know in truth, and it could well continue much beyond that. So South Africa is unfortunately looking at a shock to the fuel price system, and clearly that shock will wash through into a whole range of other data and implications, particularly for confidence and consumer activity. And no doubt it does stop the Reserve Bank cutting interest rates. If I look at our forecast for interest rates before the Iran war started, our expectation was that there would be a cut in interest rates in March. But given the latest developments, that is incredibly unlikely. I don't think the Reserve Bank would contemplate increasing interest rates to try and control inflation. They would see that as counterproductive. This is a shock to the system that you can't do much about, so there wouldn't be any benefit really in hiking interest rates. But clearly, if the oil price moves to these sorts of levels and then just becomes entrenched at that level, then it has longer-term implications for both inflation and interest rates. So that's not without risk. But I wouldn't anticipate the Reserve Bank even discussing the possibility of a rate hike. I think the debate would be, is there still scope to cut rates? And clearly at this stage there isn't. And so most central banks, not just the Sovereign Reserve Bank, will tend to want to keep interest rates on hold, adopt a wait-and-see approach, and trying to work out how long the conflict lasts and what are the lasting implications of this conflict. What does the oil price end up doing, not over a couple of days or a week, but what does it end up doing over a number of months, and therefore try and factor that into the various economic parameters. Hope that makes some sense. This is clearly a very fluid situation, and I suspect we'll be updating all of these numbers in a couple of days' time. The second topic is a quick discussion about the US labor market data that was released last week, Friday. It relates to the month of February, and during the month, the US lost 92,000 jobs, and clearly that was quite a bit below market expectations. I think the market was looking for an increase of about 50,000 jobs, which in itself would not be a particularly large increase. So the 92,000 did cause some concern. If I break down where that 92,000 loss occurred, it was very broad-based. You can't say it was just one or two sectors. There were many industries that shed jobs. There was one caveat, and that is in the healthcare space. There's been an ongoing strike. It's involved about 30,000 people, and so when you go on strike, the number of people on strike gets deducted from the US employment data. So when the strike ends, those numbers get added back. So we're looking at 30,000 being added back because of the strike. But even if you add back 30,000, you still have a negative number in the month. So clearly the US labor market softening further. If I look at the unemployment rate, it went up from 4.3 to 4.4. 4.4 is still a very decent outcome, but it has been drifting generally higher. And so a whole range of indicators suggest that the US labor market is softening. Now, that raises a concern as to why that is occurring. Some people assume that it's the impact of AI. There isn't really evidence to show that companies are cutting workers because of AI. If I look at the various industries that have been impacted by the job losses, many of them wouldn't be have a huge, at this stage, a huge effect because of AI. Things like the mining industry or most parts of manufacturing. Those sectors have lost jobs, and it's hard to imagine that AI has played a role at this stage. That doesn't mean AI is having an impact. Where I think AI is having an impact is that for a number of industries, they are reluctant to hire new people, particularly young people, into those industries, simply because they're not sure at this stage what will be the impact of AI, and they don't want to end up with too many people and then find because of AI they have to reduce staff. So there's a more cautious approach by a number of companies due to AI. But beyond that, I think you have to arrive at a conclusion that says because the US is right now not undertaking a huge amount of new investment. Yes, there's a lot of investment in data centers and software related to artificial intelligence, but if you exclude those investment items, outside of that, investment in the US is actually under quite a lot of pressure, particularly in the residential property space, commercial property, and then just generally amongst machinery and equipment. It's not as if it's all that vibrant. And so without that investment, US employment is itself not particularly strong. I don't think the loss of 92,000 jobs signals that we're going to see ongoing losses in US labor market and therefore that the US ends up going into a recession. I think that's too extreme of a conclusion. If I look at a whole range of other data that's been released, a lot of the data points have held up fairly well, and in addition, the weekly jobless claims I think are fairly subdued. In other words, if there was a build-up of job losses occurring, you would expect it to show up in the weekly jobless claims as people file for unemployment insurance, and that isn't happening. So I think what's going on here is just a softening of labor market conditions, some reluctance to hire new people, more of a wait-and-see effect. There are some negatives like the tariffs are definitely having a counterproductive effect on the manufacturing sector. I think since the beginning of last year, up until the latest number, the US manufacturing sector has lost 120,000 jobs, yet the tariffs were designed to boost US industrial production and create more jobs in manufacturing, and it's had exactly the opposite effect. So I think that we are looking at, unfortunately, a fairly soft US labor market, and it does appear that that's likely to continue over the coming months. I think the market would only really get concerned if the softness in the labor market became ongoing losses of people employed and therefore a significant move up in terms of the unemployment rate that would signal that the US is not just slowing down but is going towards a recession. Then I think market participants would pay a lot of attention, but at the moment you would conclude the labor market is kind of mostly moving sideways. The bigger effect is really the Middle East crisis, the oil price that's dominating the headline news at the moment, understandably. And I think for the next while, a lot of the data is going to be disrupted by those events. And so it's probably going to be a little bit more difficult to understand the underlying dynamics of the US economy. But clearly, the labor market is not as strong as it was a couple of years ago. And I think some of that blame has to be put on the Trump camp and the policy and uncertainty they've implemented in the US economy. That's all from me for this week. Hope it makes some sense, and we'll catch up again next week. Please remember that STANLIB Asset Management is an authorised financial services provider in terms of the FAIS Act. Also, this podcast should not be construed as advice.